Way of the Turtle: The Secret Methods That Turned Ordinary People into Legendary Traders by Curtis Faith. The book The Turtle Trading Rules refers to the sea turtles in the ocean. You might be wondering why it has such a name. The book originates from a bet made over 30 years ago between two trading masters. These two masters are Richard Dennis and William Eckhardt. They were legendary figures in the American futures market of the 1980s. As partners, they earned over $50 million in profits from the market each year on average during their active years, which was quite impressive then. Despite their partnership, they disagreed on whether excellent traders could be trained. Dennis believed that excellent traders could be developed if taught the correct trading techniques. Eckhardt, however, believed that excellent traders are born, and those who are not inherently skilled would only succeed in trading due to psychological factors, even if they were taught the techniques. This disagreement led to frequent debates. Once, their argument grew intense during a visit to a turtle farm in Singapore. Dennis suddenly said to Eckhardt, looking at the turtles, "I can train traders like Singaporeans breed turtles. Let's make a bet and see who is right." Upon returning, Dennis placed advertisements in major newspapers to recruit trainees. After a rigorous selection process, he chose 13 students and called them turtles. The trading method he taught them was named the Turtle Trading Rules, which is where the book's title comes from. Returning to the story of Dennis training traders, he gave each turtle a $1 million trading account, taught them the trading method, and made them agree not to disclose the trading rules to outsiders for 10 years. This book was written after that 10-year period ended. So, did the turtle trading rules work? Data shows that in the 4 years following their training, these students achieved an average annual compound return of 80%, collectively earning over $100 million in profits. This astonishing result indicates that Dennis ultimately won the bet with Eckhardt. The author of this book, Curtis Faith, was one of the 13 turtles. He joined the Turtle program at 19 and earned over $31 million for Richard Dennis, becoming a legend among the turtle traders. The author shares the turtle trading rules he learned and his thoughts on trading systems in this book. It is worth understanding the ideas in this book if you are interested in market trading, whether in the stock market or futures market. Having introduced the book's background and the author, I will now delve into the book's content in 2 parts. The first part discusses the specifics of the turtle trading rules. We've all heard that to make money in trading, you must buy low and sell high, but how can you achieve this? In first part, I will introduce the author's method. The second part will discuss why trading methods that performed exceptionally well in the past may not work in the future. Let's dive into the first part. What exactly do the turtle trading rules say? Before discussing this topic, we must first understand what a trader is. Traders and investors are entirely different types of people. Although both are active in the trading market, they are fundamentally different, and people often confuse them. The content of the Turtle Trading Rules is more targeted towards traders, so we need to clarify what a trader is before we can understand the boundaries of the Turtle Trading Rules' applicability. There is a significant difference between investors and traders. Investors buy stocks for long-term goals. They believe that certain assets or companies will appreciate over a considerable period. For example, people like Warren Buffett and Charlie Munger are investors. On the surface, they buy company stocks, but in reality, they buy tangible things, the enterprises represented by the stocks, including the management team, products, and market position. On the other hand, traders do not buy tangible assets. They do not buy oil, coffee, or gold. Traders buy stocks, futures contracts, or options. They do not care about the management quality of these companies or global coffee production. Traders only care about prices. Essentially, they are buying and selling risk. Since traders buy and sell risk, there must be people who must sell risk. These people are called hedgers. Let's clarify these concepts with an example provided in the book. The book gives an example of an airline company. Airlines are generally very sensitive to the price of aviation fuel, which is closely tied to oil prices. When oil prices rise, airline costs increase, and profits decrease unless they raise ticket prices, which would upset consumers. In this case, the airline acts as a hedger, needing to transfer the risk of rising oil prices. To whom do they transfer this risk? To traders, who we mentioned earlier, buy and sell risk. How do they transfer it? It brings us to another concept, futures contracts. An airline transfers risk by buying futures contracts in the oil market to hedge against risk. It is easy to understand. For example, suppose oil is currently $25 a barrel. An airline buys a 5-year contract to purchase oil at $25 a barrel. It means that for the next 5 years, regardless of whether oil prices go up or down, the airline can buy oil at $25 a barrel. Through this operation, the airline avoids the risk of rising oil prices for the next 5 years. However, the airline must also bear the loss if oil prices drop. These futures contracts, the risks associated with the rise and fall of oil prices, are what traders buy and sell. There are many types of risks, and traders buy and sell mainly 2 kinds: liquidity risk and price risk. Liquidity risk is the risk of being unable to trade, meaning you cannot sell or buy what you want. Many traders who operate in the stock market in the short term trade liquidity risk. Price risk is the risk of significant price increases or decreases. The oil futures contracts we mentioned earlier trade price risk. After understanding the difference between investors and traders, we can delve into the main topic: what do the turtle trading rules say? Before listening to this part, you should understand that these methods are specifically for traders. The Turtle Trading Rules is a mechanical trading system developed by trading masters Richard Dennis and William Eckhardt, the 2 masters we mentioned at the beginning who made a bet. What is a mechanical trading system? It is a system with clear rules and algorithms. You provide an input to the system, and it gives you an output. This system does not require you to exercise discretion, you just need to follow the rules strictly. It may sound rigid, but the author believes that rigidity is correct. People are highly tense in market trading, and every decision involves real stakes. In such situations, it is almost impossible to be entirely rational. Emotions and cognitive biases severely interfere with our choices. The book lists several cognitive biases that people easily fall into, for example, the anchoring effect, which interferes with decision-making. The anchoring effect means people rely heavily on readily available information when making decisions. It manifests as an excessive focus on recent price highs and lows in the market. These highs and lows are the anchors people use to judge prices. One bias is the recency effect. People give more importance to recent data and experiences. A trade made yesterday is more significant than a trade made last week. A trade made last week is more important than one made in the previous year. This bias makes people short-sighted in their market trading behavior, ignoring long-term trends. Another is the disposition effect, where traders are more likely to sell stocks when prices rise but hold on tightly when prices fall. Humans are not rational, especially in the stock market. These cognitive biases do not help us profit from trading. Therefore, in market trading, we need a strict system that is not influenced by emotions and adheres to the rules. Even if the rule itself is not scientific, having a rule ensures your decisions are consistent and not subject to mood changes. Achieving this is far more reliable than trading based on feelings. Let's discuss the specifics of the turtle trading rules. We all know you must buy low and sell high to make money in the stock market. Everyone knows this principle, but how do you determine when prices are low or high? It is challenging, and no one can predict accurately 100% of the time. However, if your judgment is slightly better than others, you can profit in the long run. The turtle trading rules provide a method for making these judgments. Before discussing this method, we need to understand 2 basic concepts: support and resistance levels. Imagine a stock market price chart, with the K-line moving up and down like an electrocardiogram. If you select a section of the K-line and find it oscillating between $15 and $17, the $15 level is called the support level, and $17 is the resistance level. It means that around $17, there is resistance preventing the price from rising further, and around $15, there seems to be support preventing the price from falling. Once prices break through these support or resistance levels, they continue in that direction for a significant period, creating a trend. The reason for the support and resistance levels is the non-rational behavior of people in the trading market. Anchoring and recency effects cause people to judge stock prices based on easily accessible recent information, causing the market to oscillate between support and resistance levels. Understanding support and resistance levels, the critical information comes next: when is the best time to buy? The author suggests two optimal entry strategies. The first is a short-term strategy referencing the past 20 days of price movements. If the price breaks through the highest point in those 20 days, the resistance level, you buy in and go long on the stock. Conversely, you sell and go short if it breaks through the lowest point, the support level, in the past 20 days. The second is a long-term strategy where you reference the past 55 days of price movements and then apply the same operation as the short-term strategy. Break through the resistance level, buy in, go long; break through the support level, sell, go short. It is worth noting that this entry strategy is just one method mentioned in the book. Since the turtle trading rules were developed over 30 years ago, their effectiveness is debatable. We will discuss this issue further in the second part. Continuing from the earlier topic, the next question is when to exit after entering the market. Exiting the market can result in two outcomes: profit or loss. However, mature traders first consider the terrible outcome, losing money. How much loss should prompt an exit? It requires careful consideration. The trading industry has a saying: there are old traders, and there are bold traders, but there are no old, bold traders. It means that traders who do not set stop-loss points and do not know when to exit after incurring losses will likely go bankrupt. It is crucial to remember that once the price reaches your stop-loss point, you must exit without hesitation. Any hesitation can lead to disaster. Where should the stop-loss point be set? The author suggests that if you enter the market using a short-term trading strategy, you exit if the price falls below the lowest point in the past 10 days. Conversely, if you are shorting, exit if the cost exceeds the highest point in the past 10 days. If using a long-term trading strategy, reference the past 20 days to decide whether to exit. It is crucial to follow the stop-loss point without hesitation strictly. Having discussed losses, let's look at profits. The trading industry has another saying: those who lock in profits will never go bankrupt. However, the author disagrees with this view. Selling stocks too early to lock in profits can prevent you from missing out on higher profits. So, when should you sell to maximize profits? It would help if you considered selling only after the trend stabilizes, meaning when the stock price oscillates between support and resistance levels again. The author believes that strictly following this trading strategy will enable you to buy low and sell high in the long run. In the first part, we discussed the specific methods of the turtle trading rules. It sounded promising, simple, and easy to understand, making it seem like we could earn money effortlessly. However, as we mentioned, this rule has been around for over 30 years. Does it still work today? It is a critical issue that we will discuss in the second part. Market trading is a complex system, with countless experts and scholars conducting research, so there are naturally many theories. Let's step out of the original book's perspective and see what other experts say. The famous economist Eugene Fama's efficient market hypothesis, EMH, the core idea of this hypothesis is that asset prices already reflect all available information about the intrinsic value of the assets. It doesn't sound straightforward, but in simple terms, it means that the price you see for a stock is its actual price. There's no need to research further, it is neither overvalued nor undervalued, it is worth exactly that price. Future price changes in assets are not because the asset was overvalued or undervalued, but are due to new information being released. New information, by definition, is unknown when it will appear, so asset price changes are random and follow a random walk. We previously discussed a similar view in the book A Random Walk Down Wall Street, which suggests there's no need to research stocks, randomly pick a few stocks, hold on to them, and wait for them to appreciate. However, the fundamental belief behind studying any knowledge is that through learning and research, we can summarize some patterns that can help us predict the future. If the changes in the world are entirely random and unmanageable, why conduct research? The stock market must have some patterns. Economist Robert Shiller believes that markets have bubbles and that people are irrational. The stock market sometimes goes too high and sometimes too low. Even if a stock performs poorly, as long as you believe that someone is speculating on it and willing to buy it, someone will buy it at a higher price later. Based on this understanding, many studies have been conducted on stock trading methods, and the turtle trading rules are one such method. Eugene Fama's efficient market hypothesis and Robert Shiller's market bubble theory seem reasonable, but who is right? It is a difficult question. It's hard for us to answer. Even the Nobel Prize in Economic Sciences Committee found it hard to decide. The result was that they awarded the 2013 Nobel Prize in Economic Sciences to both Eugene Fama and Robert Shiller. After discussing the clash between these two viewpoints, we can try reconciling them. Essentially, stock market fluctuations are patternless, so as an investor, if you randomly select a stock portfolio and hold it long-term, you can achieve profits. However, human irrationality is also a factor that affects short-term trading behavior. So, in the short term, stock market fluctuations follow some patterns. Returning to the original book, how does the author view the effectiveness of trading systems? Curtis Faith also believes no trading system can be effective in the long run. Let's look at his reasons. The author believes that trading systems that performed exceptionally well in the past may only do so in the present. The better a trading system performed historically, the worse it might perform. Why does this happen? The author summarizes 3 reasons: trader effect, random effect, and overfitting. Let's discuss each one. The first reason for trading system failure is the trader effect. In quantum mechanics, there is the Heisenberg uncertainty principle, which states that observation alters the state of the observed object. In the trading world, a similar uncertainty exists, which the author calls the trader effect. It means that people's trading behaviors change the current state of the market. If a trading system becomes very profitable, other traders will start noticing and mimicking it, and as more people use it, the strategy becomes less effective. The second reason is the random effect. It is easy to understand some systems with impressive historical data were lucky. Random effects can quickly occur. You don't need a complex trading system to predict stock movements with 100% accuracy. Stocks either rise or fall. If you send emails predicting a rise to 5,000 people and a fall to another 5,000, half of them will receive a correct prediction the next day. Continue this process, and eventually, some people will always receive accurate predictions every time. Of course, this 100% accuracy is in quotes. Many scammers use this method to deceive people. The third reason is overfitting. Overfitting means that if a model closely fits historical data, its ability to predict the future is worse. This counterintuitive result occurs because historical data contains errors, and precisely fitting the data amplifies these errors, making future predictions more inaccurate. The author believes trading systems should be simple. It is likely overfitting if minor data changes cause significant model prediction changes. A good model should be relatively sensitive to data. Nobel Prize-winning economist Harry Markowitz was once asked how he manages his finances. He said he puts half in stocks and half in bonds. It's that simple. We discussed Eugene Fama's efficient market hypothesis and Robert Shiller's market bubble theory. Fama believes that market prices change randomly and are unpredictable, while Shiller thinks market prices have bubbles and can be predicted. Market prices have no pattern in the long term, but human irrationality affects stock market fluctuations in the short term, creating some patterns. According to Curtis Faith, no trading rule can be effective in the long term due to trader effect, random effect, and overfitting, making previously brilliant trading systems ineffective in the future. While the turtle trading rules helped the author make much money 30 years ago, applying them strictly today may be less effective.